So just to introduce the notion of distributions to shareholders, the topic on the syllabus calls this topic dividend policy. And so what we have here is a matter of distributions to shareholders, typically called dividends. And this is one of our remaining topics in the course because we have reviewed bonds in some detail, and we know that firms make promises to bondholders. Those who lend money to the firm are promised interest and principal. And so that is a definitive cash flow, and we know well how to value bonds because of that feature. Stocks, which are shares which make up the equity capital of the firm, and recall last class we talked about the financing and how to divide between debt and equity and the considerations that come into that. Now, shares are unlike bonds in that they offer no promises to those who invest in shares. And so what we find is that we have a rather uncertain expectation in terms of what the shareholders will receive after they have purchased the shares, whether it be at the initial public offering that we have looked at in a little detail, not too much, there wasn't time, or whether the shareholders have purchased the shares in the secondary market, which is where, of course, most shareholders acquire interest in companies. And so dividends are not promised, but of course, at some point, the only motivation for investing in shares is the expectation that you will receive a return in the form of either dividends and or when you sell it, when you sell your shares. And so what we find is that we know from our valuation of shares that we look at the expected free cash flows. We had a discussion about those dividend discount models back in stock valuation. It's a misnomer. It should be distributable free cash flows that are valued. And we discussed probably at enough length how that they are called dividend valuation models is unfortunate. It should be distribution valuation models, but we are not going to change all of the terminology that's been used since that model was developed now about 5 decades ago. And so what we find is it's interesting how shareholders get returns from owning stocks. The expectation of most is that they will get some dividends and that the capital gains will provide a value that is higher than you paid for it. You may recall when we introduced rate of return very early, first session in the class, first meeting, we talked about rate of return, and for shares, it's the capital gain plus the dividend yield. Now, over almost 100 years, the average return on large shares, diversified portfolios that we know what we mean, is in the vicinity of 10% with great variance, as we know. But if we were to say, well, how is that 10% made up of capital gains and dividends? On average, again, average being a key word, accommodating a huge distribution, on average, share dividends represent approximately a 2% yield. So the dividend yield, if you go to Yahoo and Finance and so on, the dividend yield averages around 2%. For many companies, it's zero that are not paying a dividend for reasons we're going to look at here tonight. And for other companies, it's a very high dividend. And so, not surprisingly, given our accumulated knowledge through the course and awareness of that critical statement, the statement of cash flows, dividends are closely related to the investment needs of firms. So new firms with lots of good opportunities, what we call growth opportunities, and that of course is what we study in capital budgeting. We examine potential growth opportunities. And if a firm has a lot of growth opportunities, then it will likely choose to not pay dividends. And so investors are not going to be unhappy about that, provided the share price is going up sufficiently to provide their required return. And let's calibrate our discussions around the average of about 10%, realizing that, of course, that varies according to the beta. The higher the beta, the higher the required return. We're very familiar with that, so it's not being simplistic to say, let's talk tonight, as we do dividend policy, about the average return on shares being about 10% and the average yield, dividend yield, about 2%, with all of the variations embedded in that word average. And so dividends are a quite small portion of the typical company's return to the shareholders. And so this is why there's so much focus, of course, on the trajectory of the share price to give the balance of the required return that isn't coming from the dividend. And so we look here at an outline of our topics, our topic coverage tonight. I find this a very interesting topic, and on first encounter, many find this information surprising. And so that, of course, is good. We're hopefully learning something really new. So the investor preference for dividends we're going to look at. It varies widely. So, for example, as you are in your wealth building years, earning your salary, or maybe you're running your company, you will have income from that source that hopefully meets your needs for cash flow to pay household expenses and things of that nature. And so you won't have much interest or much concern about dividends, maybe. But if you fast forward to the later stage, the one widely referred to as retirement, then after the salary's gone, the business income's gone, the dividend income becomes more significant to give you a regular cash flow to meet your expenses. So the preference varies throughout the life cycle. So that's, once we think about it, going to be probably quite intuitive. We'll talk about signaling. We're familiar with the concept of signaling. We'll see that plays a role in dividend policy on a number of dimensions. We'll come to those. The residual dividend model gets way too much attention in this chapter, in the PowerPoint slides, because it's not widely used. As I speak of the PowerPoint slides, there is an annotated version that, if it's not already posted, will be. I worked on that this afternoon. I have many things to deal with, and I don't know whether there's been an opportunity for it to be posted or not, but it surely will be. So there may be a couple of slides that you don't yet have. And if you downloaded this earlier, you may want to quickly look in the file and see if chapter 15 annotated is there. Dividend reinvestment plans, we'll talk about what those are. And stock repurchases, companies sometimes buy back their shares. Stock dividends and stock splits are where they take the shares and divide them into more shares, which have a lower value. Why would you do that? Well, that's something to look at also. We'll see that, in fact, stock splits in particular have diminished quite markedly in recent years for reasons we will see and I believe understand. So dividend policy is the decision to pay out earnings versus retaining them. We know about retained earnings from our second session. We looked at where you get down to the bottom line of the income statement. You've got net income after tax, net profit after tax. What do you do with it? Well, you either pay some of it out or retain it. And that decision, as we I think, bringing it together, is going to be really dramatically impacted by your investment opportunity sets, which is another way of saying how many positive net present value projects do you have. So it's an important decision. Is it a high or a low payout? Many companies pay out, again, representative average, around 40% if they are in the dividend paying mode. Do they pay stable or irregular dividends? There is great preference for stable dividends because investors interpret dividends as having an embedded signal, and so cuts in dividends, no matter for what explained reason, often result in a negative impact on stock price, as investors interpret that as cutting the dividend is a signal from management that things in the near-term future are not looking so good. So back in times gone by, but after dividend policy got to be analyzed starting again, of course, we know that Modigliani and Miller, our capital structure contributors in 1960, led to a serious analysis of dividend policy. So back in earlier times, companies might have fluctuated how much they paid out according to, what projects they had and so on. But that is now considered to be disruptive. We're going to talk about clienteles, for example, and that's going to be clearly disruptive if you have irregular dividends. So most firms that pay dividends aim for a stable dividend, and they like it to be increasing typically at a small rate so that they can maintain that. There are those who check dividends very closely. There's some financial firm that talks about the dividend masters who have paid dividends, the master firms, they call them whatever, that have paid dividends and never reduced them over the last so many years. But we won't delve too much into that. How frequently to pay dividends? Many companies pay quarterly dividends every financial quarter. Some pay them less frequently. It's rare to pay them more frequently than that. I had a colleague who years ago studied dividends as his major research, and he found a company that paid a dividend every month. That's unusual, and they were often relatively small amounts. So the cost of processing, and it was the time of mailing checks, was quite high. It turned out it was a company, Winn-Dixie, which in the United States is a supermarket, and it turned out that many of the customers invested in the shares of the company, and they like to take their dividend check in when they purchased their groceries. That's rather interesting, not common at all. So quarterly is the typical payment. And announcing the policy, we're going to talk about that. In many cases, they just say, well, we're paying our typical and ongoing dividend, but if there are changes, they are announced very prominently. Now, the dividend irrelevance theory is the theory that almost all subscribe to now. So you will recall, and let's repeat it once, that MM in 58 said capital structure does not matter. It doesn't affect stock price. We went through the analysis in some detail to say, well, that we no longer hold that, neither did they in their later writings. But it prompted an analysis. We know that the tax shield gives us the gain, and eventually agency issues, not so much bankruptcy costs, cause it to turn down. So capital structure is relevant, even though MM in 58 said it's not, prompting, I should say, rather than provoking, prompting a very positive analysis that vastly increased our knowledge. In 1960, they wrote an unrelated to the capital structure piece saying dividend policies are relevant. We still, almost all finance professionals who have studied this seriously and observed it, agree. Dividend policy is substantially irrelevant for reasons we're, of course, going to see. So dividends, they start here on the investors are indifferent between dividends and retention generated. You retain and have capital gains as the stock price goes up with all of those positive net present value projects. Now you can actually find three theories. We're going to be focusing for very good reason on the irrelevance. Some say that dividends should be high so that the shareholders get the money quick and they don't leave it with management who might misuse it. Well, if you were investing in a company where you felt that about the management, I don't know why you would be investing in it. There's another more credible notion that dividends should be low. Now that is based on the tax process of most countries. When companies pay dividends, you pay taxes on it immediately. But in most countries, capital gains are not taxed until you sell the shares. And so, while paying a high dividend to make sure that the cash isn't left with management, they may do something wrong, that's a little naive. But the other one, paying low or no dividend because of the tax factor, that in fact has more credibility, even though the irrelevance pretty much rules despite that dimension. Now, the reason that dividend policy is of little consequence is because you can create your own dividend policy as an investor. If a company is doing well, and presumably you wouldn't be invested in it, and if it weren't, then if it's not paying a dividend and you need some cash from that investment, you can sell some of the stock to get the cash. And conversely, if the company is paying a dividend and you don't have a need for it and you like that company as an investment, you just buy more shares. Now, what's happened is the ability to do that has got greater in recent times because transactions costs that used to be 2%, 1% to buy, 1% to sell, are now tiny, a small fraction. You can make transactions in shares for under $5 or the equivalent in many countries. And so this is the fundamental underlying reason that dividend policy is really relevant, because you can make your own dividend policy at a very low cost. Now, also note, by the way, the ultimate signal that dividend policy is irrelevant is the security market line. It says that the required rate of return is the risk-free rate plus the market risk premium times beta. Now, there's no third term related to dividend, and believe me, that has been researched so much since the CAPM and all came about that no one ever finds a significant coefficient on the dividend payout ratio. So we've got really strong empirical evidence, research evidence about the support for the irrelevance. Now, as with the capital structure model, Modigliani and Miller, they had some unrealistic assumptions, but in this case, they didn't affect the conclusion. We know, in fact, from the 63 tax correction piece, it really did impact their capital structure work, but we'll focus on dividends. So you might prefer dividends, the notion of paying higher ones, pay dividends less risky than potential future capital gains. Sort of, there's an old aphorism, a bird in the hand, or whatever you like as the expression, grab it now and be certain of it. And if that was the case, investors would value high payout firms more highly, and we don't find that to be the case. As I say, lots of very serious research into that, and the real world evidence is totally compatible with that conclusion. Now, capital gains, this is, of course, the one that had some credibility. You may not want to have to buy or sell shares to create your own dividend policy, but transactions costs have become inconsequential. This was not always the case. It's not so long ago that you would pay at least 1%, and we've talked about this briefly in an earlier context, at least 1% to buy shares and 1% to sell them. So a round trip would cost you 2%, no more. And so the maximum tax rate is the same as on dividends for most investors, depending, of course, on the country in which you're operating and its tax code. But as we said previously, taxes on dividends are due in the year they are received, while taxes on capital gains are due when the stock is sold. And in some countries, you can leave them to your whoever, your kids in most cases, and the stock may not be sold for decades. And so in addition, this is a second point here, is a feature of the US tax code that we, of course, are not focusing too much on. If an investor holds a stock until their death, to whom they leave it, mainly maybe kids, can use the date of death as the cost basis. So let's say I bought a stock 20 years ago for $5 and it's now worth 50. If I were to die today and leave it to my kids, they start out with 50. So they pay taxes when they sell it on a capital gain from 50, not from 5. So that's a pretty significant factor if you've had stocks that have risen a lot before you die. Well, that's a little bit morbid, so we won't focus on that. But we all think we won't die for a long time. Okay, so the information content or signaling hypothesis says that investors view dividend increases as signals of management's view of the future. Managers hate to cut dividends, as I mentioned earlier. That's almost always interpreted as a negative signal, no matter what you say. It's a little like those seasoned issues. Oh, we need that extra money for a money tree. That can't go wrong. Perfect investment. The stock, as we know from seasoned issues, okay, you're sharing the risk. We'll mark it down 2.5% to 3%. The concept of signaling is similar with a dividend cut. You would say, oh, we need the money for a dividend, a money tree. Well, again, investors very skeptical. So typically managers don't want to increase dividends unless they are sustainable. And there can be an increase in terms of if it's a positive, a stock price increase, if there is a dividend increase reflecting higher expectations. Not necessarily the higher EPS, that's profits, of course, not necessarily a desire for the dividends per se. Now, just briefly, let me refer to some research I did now a good time a while ago about, here we're talking about dividend increases of dividend paying companies. I looked at dividend initiations of companies that had not been paying dividends, were doing well, and started to pay dividends. What was the stock price reaction to that announcement? Slightly negative, because it was signaling that those companies, and they were all companies doing well to start paying dividends, they were signaling, not quite using the words, of course, oh, our investment opportunity set is substantially already harvested. Okay, we don't have as many positive net present value capital budgeting projects as previously. And so that actually is a negative signal. That was I anticipated it and I found it. It was not dramatic, but it was statistically significant and economically material. And so if you look at all sorts of companies, very successful, McDonald's, Microsoft, Apple, these companies' best years, and these are still successful companies, note I'm not saying they're not, their best years as investments were when they were not paying dividends, because they had these incredible positive net present value projects. So think of McDonald's before they had carpet bombed every busy corner on planet Earth with a McDonald's outlet. They were wonderful positive net present value projects. So when they started paying a dividend, they of course didn't use the words, but they basically signaled to those of us who know about these things, okay, well, sorry folks, we have pretty much burned up our wonderful positive net present value investment opportunity set. We'll continue to operate profitably as they do, but the growth rate will diminish. So there are a few subtleties around dividends, and the signaling insights are those that we are now quite familiar with. Now, this is a key concept. If dividends are irrelevant, why do some companies pay consistently high dividends and some consistently low or no? Well, you know, we've got the context of the investment opportunity set in our framework, but the clientele effect is one that really helps to explain. You know, if someone says to you, did some professor tell you that dividends don't matter in affecting stock price? And you'll say yes. And they say, well, then how does he explain that AT&T pays a very high dividend and Tesla and others pay none? Well, it's a clientele effect. There are different investors, which are referred to as clienteles in business in general, but specifically here in dividend policy, prefer different policies. So investors who want dividends, maybe they're retired investors who have made investments in stocks and have no longer working with no salary, or they've sold their business. They need cash flow. They're looking for companies that pay consistent dividends. And so you don't want to change this a whole lot, because dividends, you get these clienteles that match their preference for dividends with companies that do or do not pay dividends. You don't want to have to switch often to taxes are a factor if you've had capital gains. Brokerage costs, we know, are toward inconsequential today. Now, this imperfect graph, and this is on the annotated version that will be uploaded if it's not already. You look at the firms across the top, and you have either low growth firms, of course it's simplistic, but it makes the point, or high growth firms. And we know that low growth firms have fewer positive net present value projects. They are probably generating high free cash flow and don't have good investments to use much of it or most of it. And so they'd be inclined to pay dividends. Then we take investors down the side. And if you have a low tax investor compared to a high tax, a little simple, but again, we make the point. Now, the low tax investor who owns shares is like a retired person who has made investments and now is no longer getting a salary or their business income. So they look for that steady cash flow. That's their clientele profile. And so they match up with low growth profitable firms with free cash flow and get high dividends. Now, those of us still in our earning, or what we often refer to as wealth building years, and I wish all of you, if this be part of your aspirations from this course, that you have many wealth building years and at high level. You will be in a high tax bracket, no matter what system you're in. And so that reflects high income from salary or your business, whatever. So you have no need for dividend income to pay your bills. And so you also would like to line up with the high growth firms that are not paying dividends but are growing well and may well have even extra capital gain. Because this profile, as you may anticipate, often sees the betas of the low growth firms being lower risk than the high growth, and so that further motivates this clientele matching effect. And of course, in the other two quadrants, it doesn't so work. Don't know if there are any questions on that. This is a key insight into why we see such wide variations in dividend policies, even though we maintain that dividend policy does not, in fact, impact the stock price. So these are rather key and critical factors, and it helps to put all of these things. I've had over the years a number of students say, well, I was totally puzzled when you insisted that we should think of the perspective of dividend irrelevance as we cover the topic, but then I came to see, okay, right, we can link that to what we observe in the real world, and we have a theoretical framework to so do. So the evidence on clienteles, it's widely observed pattern. So low tax investors may be retired if they're both low tax and own shares. It's sort of an interesting profile. They seek steady income from dividends as salary income has ended. Individuals in their wealth building years, when income from other sources, salaries, businesses, etc. is high, don't need the cash, seek high growth firms with many growth opportunities and low or no dividends. They're often also, as I say, aligned on the risk preferences of such folks. Those of us in our wealth building years often can be a little bit more aggressive in taking on additional risk. We're all risk averse. We want to be paid for taking on more, but that often fits with companies that are paying low or no dividends. Now, if you say, tell me the research papers that support this, I can't, because only tax authorities have the necessary data, and they won't share it for very good reason. So there's always this, well, prove it. Where are the research papers? We can't get research on clienteles because only the tax departments would enable us to undertake the research. For good reason, they don't share that information. Other clientele attributes, there's a need for great caution as dividends can be cut. Okay, so some time ago, I met an individual who was the parent of a friend of one of my kids, who regaled me with how he'd been buying a lot of GE stock because it had this high dividend yield. It was 10%, which is sort of almost unheard of. Well, I knew that GE was about to enter into a major decline because of well-advertised problems, and that the reason the dividend yield was so high was because the stock price had gone down, but they were still paying the same dividend. So the numerator stays constant, the denominator goes down, the yield goes up. Pretty basic arithmetic. And so I tried to suggest that actually could be a negative signal. I don't know I made much headway. And so there's a term used, and it's not meant to be in any way judgmental, widow and orphan shares. Those are those that pay high and steady dividends, but again, they can be cut. And in fact, a very high dividend yield, the dividend per share over the price, can be an early warning sign of an approaching dividend cut. Now, one that is getting attention in the financial press yesterday and today is AT&T, American Telephone and Telegraph, which you probably think of as a telephone company. Well, its dividend yield as of today was 6.88%. That is extraordinarily high. Well, there's been a lot of discussion about AT&T. It's originally a telephone company. It still is, but it's been on this very curious path of acquiring other lines of business. It acquired Time Warner, a media firm that makes movies and runs news channels, quite far from their core competency. And when we do a week from tonight restructuring, we will see so much evidence that widely diversified firms, once called conglomerates, are typically not successful. And it appears as if AT&T is absolutely in that trajectory. why they have made these extremely expensive acquisitions outside their field of expertise is puzzling. It's interesting that the CEO is retiring just at the point where things look to be very unpleasant. And so what's happened, they've paid this dividend of more than $2 a share, 52 cents every quarter. And the stock price has been going down. And I was not at all surprised to see in the financial news online today, rumors that AT&T dividend is soon going to be cut. And so none of you after tonight are going to be persuaded to buy a stock because of its high dividend yield. Maybe indeed a negative sign. So because of clientele patterns, companies are often reluctant to cut their dividends. For example, AT&T is classically in that profile of what is, without judgment, called a widows and orphans investor profile, someone who needs steady income. Now, when GE cut its dividend about a year ago to a penny per quarter, that was disastrous for many retired investors who had seen GE as one of the critical dividend-paying stocks to provide their cash flow, given they're no longer earning a salary. And so we've got to be careful about how we judge this. So, for example, when I was starting to read about AT&T, a company I used to do a lot of consulting for in an earlier time, I was recently reviewing their financials, and I thought, okay, I can see why the analysts are starting to write articles and produce headlines about AT&T. Now, there's this 1 penny dividend phenomenon. So GE, which is in very serious financial strife, GE, I don't know how many of you are familiar with it. It was run by a mercurial and very successful, albeit somewhat controversial individual, Jack Welch, from 1980 to 2000. Mr. Welch was a rather aggressive and definitive manager, but very successful. By the time it reached the end of his stewardship, the company had a market cap that was number one globally, $500 billion. Well, he retired when the company was at its peak. His successor stayed in place for 17 years and seemed to take one calamitous decision after another. So the question is, where was the board of directors while this happened? I checked today, the market cap of GE is $69 billion. So it has gone from being number one at $500 billion to having lost $431 billion of shareholder money in that intervening 20 years since Jack Welch retired. And so it cut its dividend belatedly because many were relying on it. They knew that, but it had to. It's in such dire straits. To 1 penny a quarter. Why would you pay a penny? I mean, again, the processing of this, isn't it dysfunctional? Well, in the US and some other countries, there's this curious requirement for certain investment funds. Maybe the endowments of universities and hospitals and so on, some pension plans can invest only in shares that are paying a dividend. And so when companies really enter negative circumstances and would logically take their dividend to zero, frequently in the US and some other countries, they drop it to epsilon, a penny per quarter, so that they are still eligible as investments in funds and institutions that are required to invest in only dividend-paying stocks. Some interesting material here. The catering theory is that investors' preference varies over time and that corporations adapt their dividend policy to cater to the current fad. Not a whole lot of substantiation from that. That's a theory that is not considered to explain much in the way of dividend patterns. The residual dividend model, I tended to almost dismiss it as we started, and let's see why. What happens is that says, okay, you've got some profit. How many positive net present value projects have you got? What is needed for your capital budget? Just pay out anything that's left over, the residual. That's why it's called the residual. Well, it minimizes flotation and equity signaling costs. Well, I don't know about the signaling, and hence minimizes the cost of capital. But of course, it gives you these wildly fluctuating dividends. And we have just been through the very substantial and important clientele effect. So the residual dividend model would have your dividends fluctuating widely, could be wildly, depending on the capital budgeting positive net present value projects of a particular year relative to the previous. So there are some numbers here. We're not going to go through them. You won't be asked to, because the dividend residual model, know what it is, but it is not widely used. I'm not quite sure why they spend so much time on it. So they go through these little examples. Would you pay out dividends, or would you not, and so on, depending on the size of your positive net present value projects. So how would the investment opportunity affect it? Fewer good investments would lead to a smaller capital budget, and a larger payout, and conversely, not widely pursued. An advantage, you don't have much new stock issue because you're just using it as a residual, but look at the disadvantages. Variable dividends, conflicting signals, riskiness for investors, and again, it just doesn't match up with clientele, any particular clientele, and that is considered to be a very important attribute of dividend policy. So residual policy when setting long-term target, but don't follow it year to year. Certainly don't follow it year to year. And so they step back and say, well, what do you do here? Forecast the capital needs over maybe that 5-year horizon, a target capital structure, estimate your annual needs, and set a target payout ratio. If you can even the residual model out over a horizon, it could be some signals. But dividend growth rate emerges. You maintain the growth rate if possible. We spoke about that group of so-called dividend high performers. I think they call them dividend masters, if that term is applicable. Varying capital structure somewhat if necessary. Okay, let us now look at something that helps to address the fact that dividends are essentially irrelevant. A dividend reinvestment plan is where you sign up with a company and say, when you declare and pay a dividend, do not send me a check, buy more shares. So you like the company, you want to be invested in it, and so you don't get the dividend, the check or the money. You tell the company to just use that to purchase more shares for you in the company. Now, these are very, very common. Many shareholders use them when they don't need the cash flow for reasons we've profiled, but the company is, for whatever reason, paying a dividend, maybe a small one. And that means there's a need for caution. If you sign up for a DRIP, dividend reinvestment plan, and the dollar amount, the monetary amount of that dividend is small, take a close look at it, because some of them have fixed charges each time the DRIP happens. So, I've seen, well, if you sign up for the dividend reinvestment plan, you also authorize that the company can charge you $10 or $20 or some percentage for doing it. Well, the percentage is probably going to be okay. But let's think about it. If you're getting a $50 dividend and the company charges $10 to process it, that's a 20% transactions costs. So just be a little careful. This is a very important attribute of DRIP plans that does not get nearly enough attention. Okay, so we know why they're there, but we don't want to be losing a big portion, 20% or more of our dividend in processing fees. Now, where does the company get the shares? Well, it can buy them on the open market. The company can buy its own shares, or it can issue new stock. And so that's what happens. Open market purchase, turned over to a trustee, some bank or something, buys the shares, very high volume, so low costs. It's an easy way for it to do. In fact, investors don't necessarily know which model the company is using. New stock plan, the firm issues new stock, often at a bit of a discount. And so that helps them to get new equity capital. It's a small amount. I mean, we're not talking large percentages here, but it is a source of additional equity for firms because, as I say, many investors sign up for DRIP plans with the caveat on transactions costs I mentioned being important. So most New York Stock Exchange listed companies have a DRIP. They make it easy, and not just New York Stock Exchange, but major stock exchanges, Paris Bourse, Tokyo Exchange, and so on. Many companies, large companies, offer this to their shareholders. Now, stock dividends and stock splits are similar. The only difference is stock splits are bigger. So this is where instead of getting a cash dividend, you get additional shares. So a stock dividend, the firm issues new shares in lieu of paying a cash dividend. If it's 10%, you get 10 shares for every 100 owned. Okay. Now a stock split is very similar. It's just a matter of scale. So a stock split is a big stock dividend, essentially. And sometimes the arbitrary cutoff of if it's more than 25%, you start to think of it as a stock split. Stock splits are often much larger. And a very common one in practice is 2-for-1. So in other words, if you had 100 shares today, and they have a 2-for-1, you have 200 shares tomorrow, but the price is halved. And so there's debate about, what's going on here. Is this simply a paper shuffle? And for reasons we're about to see, there's a decreasing level of stock splits in recent years. In times not so far back, there were lots of stock splits by successful companies. And so this relates to average stock prices. There's a wide range of prices for one share. There are, in most capital markets, literally what are called penny stocks. Some of them are literally 1 penny, and they're normally going to be 0 tomorrow, but we won't go there. Now, in the US markets, the range is from 1 penny per share to today, Berkshire Hathaway's A shares were selling for $287,961 for one share. One share. So to buy one share of Berkshire Hathaway's A shares, you need $287,961. It's down a little bit. Before things went a little crazy, they actually topped over $300,000 for one share. Now, this all relates to Warren Buffett, the famed and very successful investor, and not on a hot run just the last while, but overall, when you're worth 70 billion, you've been successful. He doesn't believe in stock splits and never has. In fact, he used to write, as Berkshire Hathaway got to be very successful, he used to write in the birthday cards to his friends, "May you live until BH Berkshire Hathaway splits." Well, that got to be interesting in 1995 when the Berkshire shares were $30,000. They've done all right, okay? $30,000 in 1995, 287,000 today. They've been good investment. Well, two young finance graduates decided to start a mutual fund that would solely invest in Berkshire Hathaway stock. Because a lot of people like to invest with Warren Buffett, the famed investor, but they didn't have $30,000. So these two finance graduates said, here's our mutual fund. We'll sell it in $1,000 pieces. When 30 people have sent us their 1,000, we will buy a Berkshire Hathaway stock, and so on. Well, that was interesting. They were well trained. They were honest. There was nothing dishonest. Warren Buffett, of course, heard about this, and he said, I've checked these fellows out. They're fine young people, well trained. There's nothing illegal, no mystery here, but they can't make their money solely on me, their business solely on my success. Well, he couldn't split Berkshire Hathaway because he'd written this to his friends that they should die if he splits, basically. So to get around it, he created the Berkshire B shares. And do you know what? They were 1/30th of the shares, which came to be known as the A shares. So they were $1,000 shares, exactly what these two entrepreneurial young finance graduates had proposed. Of course, it totally scooped their business idea. It didn't split Berkshire Hathaway, but now Berkshire Hathaway has A shares and the B shares 1/30th. Okay, interesting stuff, but 287,961. He doesn't believe in stock splits. His good friend Bill Gates of Microsoft, they used to apparently debate this. Microsoft for years kept its stocks around $30 by splits, even when it was just doing extraordinarily well. That split often, maybe more than once a year at the best times. Today it's selling for $211.75. What gives? Well, I said stock splits have diminished in importance and frequency quite dramatically. I saw some summary data on it recently. There was a prior rationale for tradable range of shares in the $20 to $60 range. And we know why. We go back there to risk and return. You need at least 20 shares to create your own efficiently diversified portfolio, right? And so we know that graph that we had back there, critically, get the unique risk down asymptotically towards zero. At least 20 shares. The graph showed 40, but 20 can pretty much do it. You buy them in round lots of 100. So how much did it cost you to build your own efficient portfolio? 20 shares, 100 of each. If the average price was 40, you could do it with 80 grand. Okay? And so companies tried to keep shares around affordable. And 40 was a common goal, literally. And that range of 20 to 60 accommodates that. Well, of course, now that's a nice story, but it's got a bit of a history because you can buy an index fund that's super efficiently diversified, starting with $50, okay? And so the tradable range, the stock splits to accomplish that, they are diminished markedly over the last 10 or 15 years. This is what some companies were doing with the successful. So classically, you would find companies, there was a company, Coca-Cola, successful in its best years through the 90s. It would go from 40 up to 80, that split 2 for 1, drop it to 40. A couple of years later, it'd be back at 80, that split, and so on. And so this was the tradable range story. There were other companies that really follow very similar profile. And so what happens is, what has happened here? Okay, I think I've gone back here. Both stock dividends and stock splits increase the number of shares outstanding, so the pie is in smaller pieces. But unless there's information, what do you get? You have 100 shares worth 80 or 200 shares each worth 40. There are those who just consider this to be a total paper shuffle. Some research found that companies tended to split only when they were subsequently doing well, and there may have been a signal in there. Conveying information is what signals do, and so on. And the optimal price range was the key thing. So that was why the price range here, but we're skeptical. 100 shares at 80 is worth 8,000, and 200 shares at 40 is worth 8,000. Is it just a paper shuffle? A lot of debate about that. As I say, some research found that companies typically did particularly well after splits, re-endorsing the notion that a split will take place only when you're optimistic that things will carry on and it will be a good play out. So confident is the issue. They outperform the market following a split, but only a little. That you really have to fine-tune the statistics to find that. Now, one thing before we do stock repurchases, you can have a reverse split. If a company's doing badly, many stock exchanges around the world do not want shares to be selling for very small prices. This penny stock stuff has a bad image, and you don't have to be literally a penny. But for example, a New York Stock Exchange will consider delisting companies if their stock price drops below $5 a share. So let's say you've dropped to 4. Oh, we don't want to be delisted. Let's have a 1 for 10 reverse split and increase the stock price from 4 to 40. So reverse splits, relatively rare, but in fact, as regular splits are diminishing, when companies get troubled, reverse splits are proportionately, still not high, but proportionately being a larger part of the picture. Stock repurchases, where the company buys back stock from stockholders. Why would you do that? Well, there's a perception that challenges market efficiency. The management think that the stock price is not reflecting what the company's worth. You know, the efficient market says, where's your logic for that? But that's the rationale. They also can do it as an alternative for distributing cash as dividends. Sometimes there's a tax benefit for shareholders in that. If you need to make a large capital structure change, remember our discussion last time, if you find that you have to increase your leverage to get to optimality in the value cost of capital relationships, this is a way to do it. And sometimes to get stock for when options are exercised. The classic technique was the set price, where the firm offered above the market price to buy back shares. The set price offer is considered to be narrow and efficient as time goes by. The price was often so high that many more shareholders offered them back than the company wanted to purchase shares, so they had to prorate the repurchases. More recently, the Dutch auction is used to do shareholders. That's where the company invites shareholders to offer to sell back shares within a price range set by the company. And this sort of captures it. So you have the old classic price and volume on the axes. And so if the firm's goal is to purchase where I've indicated, if you offered your shares back at either prices 1 or 2, you get to sell your shares back. If you aimed high at 3 and 4, the company doesn't buy back your shares. Now you may say, do 1 and 2 get different prices? For legal reasons, they don't price differentiate. In this case, 1 and 2 and wherever it intersects would all get $40 per share. So repurchases, contender or not, helps avoid a high dividend that cannot be maintained. Repurchase stock can be used in takeovers or resold. Remove a large block overhanging, and that may be considered a positive stock. Disadvantages can be interpreted negatively. The IRS doesn't typically impose penalties to tax authorities, but they could if it was just to boost capital value and so lower taxes compared to dividends. And so we know about having to bid up the price. let's see. Okay, this is the practical dimension as to how dividends are paid. So that standard quarterly dividend, how is it paid to shareholders? There are 4, maybe 5 key dates in the payment of dividends. Sometimes the company will informally say, we intend to pay a dividend. They're more likely to do that if they are intending to increase it, okay? But they don't often, certainly not always, say we are intending to. What is always going to be there is the definitive announcement. We are declaring a dividend of 50 cents this quarter. Now, it gets to be interesting. Who gets the dividend? Let's say I am looking to buy the share from you. Then you say, well, just a minute. Let's take the dividend. The stock price is 40, and that it's going to be $1 dividend, just to keep the numbers even. So the stock price today is 40, but it's going to pay a dividend of 1. Now, after the dividend is paid, the stock price will be 39. Stock prices always drop by exactly the amount of the dividend. There have been all sorts of games played to try to make money on that. There's no money to be made. There's no arbitrage in there. So on the date of record, those are the shareholders in the register who receive the dividend. Now, if you buy it the day before the date of record, who gets the dividend? Well, we need to be definitive on that. So the company sets the date of record and the exchanges set the ex-dividend date. Ex-dividend is the first day on which a buyer does not get the upcoming dividend. So on X day, the price of that situation we profiled, the share price will be 39. The day before X, it'll be 40. And so obviously the X date is critical. That's why in most financial publications, whether they be printed or online, if they're comprehensive, they will declare the upcoming X dates for major companies over the coming week. You can see why that's important. You need to know if you're about to purchase that share, whether or not you get the upcoming dividend. So the ex-dividend date in US markets is currently 2 days before the date of record. In intermediate times gone by, it used to be 1 week because, you know, if there's a share transaction, you have to notify the company to get the new owner on the record, on the register by the date of record. So in the not so distant past, a few years now, maybe 15 or 20 years, it was a week. But of course, this stuff's all electronic, don't need to take a week. And in US markets, the X day is 2 days before the date of record. Then after all of this, typically 30 days or somewhere later, the payment is made. And this, so the company announces it definitively, sets the date of record and the payment date. And the financial markets back up the X date, that's how dividends are paid. And of course, most of it's now electronic payments in finance company records and the company records. The sequence is very occasionally changed for large and unusual dividends. So just make a note, particularly as we've run over our time, that we'll see that a week from tonight when we do spin-offs, which are indeed large and unusual, where a company splits into 2 or more pieces. So that completes our coverage on dividends.